Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending December 6, 2019. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is really wash, rinse, and then repeat. Before I get into the details though, the Dow this past week, pretty much most of the markets were flat all week. I mean, the Dow was down 13 basis points. It's 13/100ths of a percent. The S&P was up 16 basis points. The Nasdaq down 10 basis points. The Russell led the way, up a little over 0.5% for the week. And of course, we saw volatility tick up just slightly under 8% for the week. It closed the week at 13.62, up from 12.62's close last week, the prior week. And in the world markets is pretty much the same, although the FTSE, which is over in London, was down 1.45%. The CAC 40 down 56 basis points or 0.5%. The DAX was down about 0.5%. The Nikkei was up about 0.25%. China was down 1.4%. The Hang Seng, the Hong Kong index, was down about 0.5%. So the markets were flat, mostly to slightly in the red for the week, although we did have a strong finish. The best performer for the sector this week was energy, up about 1.5%. Consumer discretionary was the worst performer, a little over 1%. The trailing PE ratio for the S&P right now stands at 21.33. That's a known prior 12 months. And the forward PE is 19.18. So it's lower by about 11.9% or so compared to the trailing. And then the current dividend yield for the S&P is sitting at about 1.85%. The 10-year interest rate's at 1.84. So net, it's a wash. And generally, when you have the dividend yield in the S&P slightly larger by 1 basis point, but essentially better than the 10-year interest rate, it's going to continue to funnel money into the markets. Okay. But this past week, it was all about jobs. It was all about the jobs this past week as we ended the week with an outstanding monthly jobs number. Came in, the non-farm payrolls jumped to 266,000. I'm sure for you guys that are especially active in the market, you're probably already aware of it. It's about 100,000 more than economists expected. And it revised prior months as well, up by 41,000. And even if you strip out the GM strike, which kind of added 40,000 to the number, it is still a great, strong number. In addition, the unemployment dipped down to about 3.5%. The labor force participation rate remained at near 10-year highs on a backdrop of low inflation and a supportive Fed. So this is kind of like a Goldilocks type market, guys. Price action loves this stuff. These are all really great numbers as we, in about 3 weeks, this decade comes to a close and we move into the roaring 20s, but not the 1920s. That would be the 2020s. So more on that in just 1 second. But basically, the market's registered its approval of these job numbers with this strong finish to the week. Although really the beginning of the week we saw it really didn't start off very well, right? That was on the back of a slight move lower in the prior Friday, and then we moved down Monday and Tuesday. Basically, the excuse at the time was Trump had levied tariffs on Brazil and Argentina, with his statement that they were devaluing their currency. And then Trump followed up, at an offhand remark over in NATO or over in a meeting in London when he basically said that he could wait until 2020 elections to get a deal done with China, which kind of implied that the December 15th tariffs, which are next weekend on 160 billion in Chinese goods, would hit, right? Which, by the way, they may still hit. Some argue that with these big, strong numbers here, the U.S. economy, net's really not being affected by any of these tariffs that we've currently implemented against China. So they're arguing that Trump should just continue to drive and seek more concessions and just let those tariffs on December 15th hit. Well, it's still, I believe it's still a 60-40 where he's going to move those tariffs out. All right. I think he wants to get a deal done before Christmas. He'd like to see some more good news and wrap up this decade that way. That's kind of what I'm sensing. But let's see what he does. I mean, we're just one Trump tweet away from yes or no. I suspect we'll know before we move into the weekend on the December 15th tariffs, because that's officially on Sunday next weekend. So I suspect we'll know before then. Either way, most economists really expect good things for 2020, but not at the rate that we had moved up in 2019. Okay, I mean, we're not expecting a Fed rate hike. They're probably going to stand down. They pumped extra liquidity into the markets, but don't call it QE. And Morgan Stanley sees the next decade, really the returns for most indexes coming in a lot less than they've been over the prior 10 months, or 10 years rather, past decade, which would make sense, okay? Because markets tend to revert back to a mean or an average. And if you go back over a century, that would probably do it, bring us back down to 5 to 7% returns in the indexes. Okay. Now we do get the Fed's meeting next Tuesday and Wednesday, Wednesday being their policy statement day. And then we got Jerome Power Ranger Boom Boom Powell stepping up to the podium to put out his pronouncement. Market's going to follow it very closely, but basically we expect no changes. I don't expect any changes. I still expect accommodative Fed. He'll use language that try and parse it. You know, it's just you're going to be looking for a do word here, a different word there. Markets still are putting in a better than 50-50 chance we'll have another rate cut next year, 25 basis points roughly. Now, the one area where I see a lot of promise, I've been talking to our members about it now for the past 4, 5, 6 weeks. We've been kind of getting into it a little bit early, but I just thought I'd pass it on to you guys too. I see small cap, primarily the Russell, but U.S. small caps underperformed large cap, mostly in the Dow and the S&P for the past 8, 9 years. And it's lagged the broader market tremendously. All right, so current valuations in small cap stand about 2 deviations cheaper relative to the S&P. So the upside looks more promising for small cap, assuming the markets don't tank early next year in 2020. And also, this is also the most seasonally bullish time for small cap as well. And it's one of the stats I saw that was really interesting is it's been over 52 weeks since we've made an all-time high in the Russell. And whenever we go more than a year from making an all-time high, then the following 12 months after that, on average, the Russell outperforms 10 out of 11 times. And that goes back to the formation of the Russell right in the early 80s, right? With an average gain of 15.2%. So that's on the back of Bank of America saying small cap should outperform in 2020 as well. So for our members, this Sunday evening, I'll go through some really interesting ways to play small cap without just trying to pick a needle in the haystack with, a handful of stocks. There's a couple of different ways to play it outside of the Russell itself too. That should be interesting. Also keep in mind the Russell is more heavily weighted financials and biotech than say the S&P. So it makes it a little bit more sensitive to market downturns, but I think there's going to be some opportunities there. And then one final note, next week on Thursday, December 12th, we get the vote to see if Boris Bulldog Johnson's going to solidify his control of the British Parliament and kind of bring an end to this friggin' toilet paper stuck on the bottom of your shoe Brexit dilemma. Hopefully by the end of January. So if the vote goes through where the Tories pull in, the Tories are the conservatives and the liberals are, I don't know what you call them over there. But I think Corbyn's probably going to lose some seats. Boris Bulldog Johnson's going to gain some seats. So that'll be good for him to line up the votes he needs to just exit Europe and the European Union by the end of January. Now, that's also going to affect the U.S. and currencies, primarily the British pound, the euro, and the dollar. I've been talking to you guys, members, those of you that are members in our user group. I've been talking to you about it. We've got some great plays in it. We've been playing some of this stuff for a little bit on and off for a while because I like currencies. They tend to trend. If you're not a member, I highly encourage you to come in and check us out. We're doing well. Next year's going to offer up some surprises. It's not going to be as easy as this year. Just throw a dart at the wall, and no matter what you hit, generally it's probably going to go up. Next year's going to offer some twists and turns that make it unique. What I've got on the screen here is an Ichimoku, a weekly chart. You can see I've got an Elliott wave pattern on here. 3, 4, and 5. And those of you that tend to follow Elliott wave know that the 5 leg is generally the end of trend, and then you have kind of a ABC kind of pattern where it kind of goes something like that, and then at the end of the A leg, and then the B leg, and then the C leg, depending on where they wind up, is going to kind of help dictate, where to next. Okay, I've also got some fib nodes plotted on here from a prior pivot low. This 4 leg down here was the worst of December of 2018. Now, this is a weekly chart, so it goes back in time. And the prior 3, Elliott wave 3, was the prior all-time highs before we gave it all up in October, November, and December of last year. And then we've just had this really good run, pretty much for all of 2019, right? A lot of this run, though, is due to the severe move lower here in 2018 at the end of the year. So we had a really good start to the year based on that move. Okay, if I go back to January or February, late January, early February 2018, the move up is not as strong as the mid 20% returns that we're seeing now in the S&P. But if you look at the markets here on this weekly chart, you can see here that even though we had a good strong up move, um, this weekly candle right here, let me just blow it up so you guys can see it. You can see this weekly candle. We closed up at the top here. This low here is 30.69. I'm going to watch that over the coming weeks to see that that holds up. I suspect we're still, even with those strong job numbers, we are susceptible to a bigger move down, at least down to the 3100 level, right? Which would get us, I don't know, it would take about 45, 50 points off the S&P right now, real quick. But you can see these fib nodes where we're sitting right now, right on this 38% fib extension off prior pivot high, which was the all-time highs made in September of 2018. Okay, that prior all-time highs rather. So that's kind of what I'm looking at on the charts. You can also see here the cloud, which serves as a support zone, and you can see the cloud kind of just moving higher and higher as we move forward in time. So needless to say, we've got a lot of solid support beneath us. I don't see a recession in 2020. I see a little bit more volatility come into play in 2020. I do see some pullbacks. I define a pullback as between 5 and 10%. Generally, on average, we have at least one 10% pullback per year. And you can just run those averages going back 100 years, and you'll see that. Some years we don't, but generally we do. That's the average. I was looking for about a 2 to a 4% dip. I thought we did get 2% actually. By end of day Tuesday, we were down about 2%, and then we had that strong rally on Thursday or Friday to bring the markets back to about flat for the week. But you can see here where we're sitting. Now, if I put it on a daily so that you can see the daily in the Ichimoku right here, you can see that down move. And this was Friday and then Monday and then Tuesday. And then come Wednesday, we started moving up. We took out Tuesday's high on Thursday, and then Friday we had the jobs numbers, and we're kind of sitting right at this point right here. You can see the MACD is kind of rolling over just very slowly, which would suggest that it's not really what I would consider a bearish divergence, or what we call a bed. But you can see this is even more pronounced. You see how the green zone down here called a cloud and an Ichimoku is moving up very strong. So it's showing that as we move forward in time, the support is going to get closer and closer to where we're sitting. Okay, so and this can be just a support zone, making it easier to fall below that support zone. But I do believe we still got some bullish momentum as we go through the end of this year. But a lot of it's going to depend on this coin toss with the December 15th tariffs. There'll probably be an initial reaction to it if Trump allows those to go through. I don't think he will. We'll see, but I don't think he will. Okay. Now, if I switch the screen over and just take a look at it with another type of thing here, let's go take a look at it with Bollinger Bands. And in this particular case, we're going to look at it with 3 standard deviations. Typical Bollinger Band has 2 standard deviations. I've run it 3. I show the 1, 2, and 3 so you can get a better idea of the accordion effect as vol comes in and vol moves out. You can see here, generally in an up move, as I've said many times before on this weekly roundup, that generally when you're in a nice solid bullish move, it's going to move between 1 and 2 standard deviations off the 20 EMA, which is the yellow line in the middle of the Bollinger Band. And then you can see a 1 standard dev move away from the 20 EMA, both up and down, and a 2 and a 3 standard deviation move by each of these colors on the Bollinger Band. You can see here where we moved into an oversold condition, and then we moved down, right down. Notice we caught it right on the 50 EMA. I like to use not the 50 EMA, the 50 on the RSI down at the bottom down here. I like to say that is a solid support line for us. You can see we just bounced really hard off of it right at this level here. And we've moved back up again. Okay. So if we can stay above the, I want to see at a minimum staying above the yellow. You can see the trajectory of the vector, the upward vector. In fact, the upward vector of the Bollinger Band is all kind of pointing like this, right? So it does tend to suggest that it wants to move higher. But I do believe that if we don't get that, if those trade tariffs do hit, or we get some word that they're going to hit, then you'll see a kind of like this event right here, which is what happened on Tuesday and Wednesday of this past week when Trump said I could wait till the end of the election or wait till we get through elections into next year before I decide to do something with China. Okay, so we're still in this uh, um, wash, rinse, repeat market because it's almost you can we've tracked this all year long. You know, markets are looking overly bullish, then Trump gets a little bit bearish China trade deal, and then the markets start to move down. And then when they move down far enough, he comes back out and says, we're now making progress. Looks like we might be able to get something done, and the markets move back up again. I mean, we saw all of that wrapped up into this 1 week, right? And we've just seen this over and over again. The markets are getting better at not trying to overreact to these things like it did earlier this year. But it's still kind of the wash, rinse, repeat kind of mantra that we've seen all year long. Okay. Um, if we come over here and let me just put it over on the um, volatility chart here. So let me just come over here. I'm gonna find vol and then just move it to a different chart here. So let me just do this. Let's find out what screen I got that sucker on. Okay, here we go. It's screen number 5. So if I move this over here, you can see in vol on this daily chart, you can see I've got different color codes on here. Okay, these color codes are just helpful reminders for folks, you know, of what phase are we in with volatility. We're in the green going down or green going up, right? We were in the yellow moving lower. Now we're in the green moving lower. So that just shows that the momentum right now is for vol to go a little bit lower, right? We're seeing in the commitment of traders report there's as much shorting activity in the volatility futures as there was in January 2018, which created a massive, massive short squeeze, flipping volatility from the low 12s, below 12, up to over 52 in overnight action. And it literally moved in about 4 days. And the last day when it flipped up to 30.52, it moved up over 20 points. And then it came back down the next day to settle in around 32. But it was a 20-point move in an overnight action. And it closed down XIV as one of the ETFs that tracks volatility, and that was the short squeeze. So now there's a little bit of a fear that there's more shorts out there in the volatility market. So we've got to be very susceptible and appreciative of what can happen if the markets do have a harder down move. You'll see a rush to cover those shorts in vol futures, and that tends to drive the volatility index up faster, right? The VIX up quicker. So we just got to be very careful of that. So that's a little bit about what I'm seeing here. And if we look at the front month volatility skew, you can see here earlier in the week we were in the red, but we moved back down into the green again with the vol skew, which means we're in a contango environment. So that's a normalized volatility skew, which means the fear is not there in the markets. And if we look at the back month, I mean, the back month is, look at this, folks. I mean, look how deep in the green we are, right? I mean, we're well enconced in the green area here on the vol skews. So the more in the green we are, the less the fear is. And generally, when you get a very low fear kind of market, then the odds favor fear to come back in. It's just the nature of the way the markets move. But this does mean that in this area of the green, that option premiums are a lot cheaper than they normally are. So picking up puts or picking up hedges to hedge any potential downside move as we move into January is a lot cheaper now than if you wait for a volatility explosion. Okay. Of course, if we look at treasuries and we look at the bond market, as you can see here, I have been telling our members since we first got short bonds back over here, we really almost hit the top, right? I think we missed it by a day, right at the end of August, picking up shorts in either the bond market or TLT. And then the regression channels started to form the minute we had a second peak here. And then we've just been making a series of lower highs and lower lows. and staying within this regression channel. And I told you guys last Sunday, and you can see the 50 EMA here, I favor shorting bonds rather than going long bonds, even though we had that big move up over 2 handles in one day. I mean, just a rush here on the 3rd of December. But you can see here that was on Tuesday when the markets really came down pretty good. The bond market gave it all back up again, right? And that was a good opportunity to just sell bonds at that peak. It's a really good opportunity to. And if we look at interest rates, we'll look at the 10-year. All right, you can see that 10-year is still moving higher. I forecast the 10-year is going to continue to move higher. Okay, the only thing that's going to push the 10-year down is that if we have an implosion in the markets, which I don't see, to the downside, forcing money back into risk-off type assets like bonds. I don't see that happening right now. I really don't. I see and that's one of the reasons why I like the Russell, going into 2020 with a heavier weighting towards financials than, say, the S&P. But I think small caps going to outperform as well. If we come over here, and speaking of small caps, if we do look at the Russell, let's just take a look at the Russell futures here. The Russell futures was right behind the Dow as far as the best performer. You can see we made 2019 highs here in the Russell. And this is a daily chart. I've shown this chart to you guys before, but I did say that if we break out of this area, right, and this area is this shaded zone right here, right, and then down below is down this area right here, right. We were kind of trapped between this shaded zone, and then I could draw a shaded zone down here like this. Okay. And when we were down here, I was watching it very closely. We didn't have any closes below that level. The closes for the day, even the day, we closed either right on the line or slightly above it. And then we came down and we tested it multiple times. But that suggested we were moving higher. And then we got up in this area here and we stayed here for 2 weeks. And then we finally broke out. We came back down and then we broke back out again. That second breakout is a little bit more bullish than the first one. Okay. And that gave us a 2019 high of 1640. So if we were to kind of just dance it back just a little bit, right? And then if we just kind of, let's just move it back a little like this, you're going to be able to see that the all-time highs are sitting here at 1746.30. If I put it on a weekly chart, it'll probably be a little bit more clear for you. You can see here on this weekly chart, that shaded zone that we just broke out of, you can see it's forming a 3-4-5 Elliott wave pattern here. And the 5 leg can move up even higher, okay? And I told our members if we break out here, it's going to be more bullish to the upside. And I do believe if they get that third leg of the bar stool complete, which would be the phase 1 of the China-U.S. trade deal, psychologically and sentiment-wise, it's going to move the markets higher, okay? I think at the end of the day, it doesn't really mean much to price action longer term. I mean, the numbers are what the numbers are, but I think psychologically near term, it'll continue to keep the momentum in the charts, and we can see everything continue to run higher. Okay, so that's a little bit about what I'm seeing there. And then, of course, if we look at currencies, let's look at the British pound. British pound did break out of that regression channel, as I've shown you guys before. Let's put it on a daily chart. It'll even show you the extension of this right here like this. And this is why I like currencies, guys. I mean, look at that regression channel on that daily chart. It's a fairly tight channel, 0.96. It's almost like a straight line. But you want to be short this thing, right? And then once we break out, it's like, let's cover our shorts and let's get out of it. And now we moved up here. This was almost like a bull flag, but we couldn't get out. We finally broke right back here on the 4th of December, right? So we broke here on Wednesday. And that's of the view that Boris Bulldog Johnson is going to be able to get a positive vote this week. You can see that my system is forecasting an Elliott Wave 5 up here around 134, even as high as 138. It's undervalued, I believe. But I do believe that should he get a positive vote, this is going to be bullish the British pound. It's also going to be bullish the euro, and it's going to weaken the US dollar. Okay, so a way to play this for members, I'll show you this Sunday evening some different ways that we can play this, some nice ways to capture some Monday on this thing when it hits this Thursday. I mean, that's what I'm looking at. And if we do look at the US dollar, okay, you can see how the dollar, when we get in the upper boundary of this regression channel to the upside, and it's a very wide channel, okay? It's very wide. It's about a 0.51 factor regression channel. So that just means the dips are wider and the rallies are bigger and longer. But we're down in the lower area of the channel, which suggests, and you can see the 200 EMA, it's trying to hold, but I think we're going to find the bottom of this channel. Should Boris Johnson come away with a solid victory, it's going to increase the value of the pound, probably the euro. And remember, the pound is about 12% of the value of the dollar index. The euro is about 58%. So if those two are stronger, then you almost are assured that the dollar is going to get weaker, all right? Because the dollar is a relative index to the other currencies, okay? We come down and we look at gold. A weaker dollar is going to be positive gold, but gold is still in my down channel here. We played this beautifully here back when gold broke out in June 20th, right? We had some signs. Let's just go long gold. We went long silver because the ratio of silver to gold is better. We played it to the upside and then we took profits. I basically put on some deep in the money puts, so I'm hedged all the way no matter where it goes. But you can see gold moved up, but silver outperformed. It moved even higher, right? You can see with this channel with silver, it moved up faster off of the where our entry point was back down in this point right here, and then we just rode it straight up. So it was a good trade for us. And you can see now we're in this big, huge Elliott wave 4 pattern to the downside. I don't see it going too much lower than this, possibly stopping at the 50 EMA. I think I had said, 1600 to 1650 was kind of where I was thinking, and then it's going to find a brief. There is no bullish divergence on any of these things here. In fact, it would suggest it can go even lower, maybe down to the 200 EMA. All right, so we'll see how that thing fares. Of course, if we look at oil, we had Vienna, the OPEC meeting this past Thursday and Friday. You can see oil is moving up on that very tight pattern of 0.87 factor on the regression channel. You can see we've stayed in this tight pattern here. OPEC came out and said they're going to extend to March. They're going to cut production another 600,000 barrels. But that's the only way they can keep oil up. It's kind of a false kind of thing, much like pumping money into the economy. Although this is even harder because a lot of those people cheat anyway. So if we can get up just a little bit higher, I'd be more interested in shorting oil than going long oil. Okay. On this big move here, as you guys know, it's when the cruise missile hit the Saudi Aramco refineries, and I had suggested, at least to our members, we should short this thing right in our chat room. It was a nice golden apple that fell off the tree. Rather than having to pick it, it was sitting right in front of you, and that's what we did. So it turned out to be a great shorting opportunity. Right now, I wouldn't short or go long. I think the momentum may carry it up a little bit, but I just, if we see strength in the global markets, then I do believe this can run up to the low 60s again, but I think it's going to run into trouble in the shaded zone up here. Okay. And of course, if we look at nat gas, nat gas is just, we traded nat gas really nice back over here. We were bullish nat gas using bull call spreads or bear puts, or bull put spreads or bull call spreads, whether you wanted to do a debit trade or a credit spread. It didn't really matter. It was a good trade for us, and then we got out of it. And then back in this move here, it was also another bullish move. Right up in this here, right over here, when we hit this peak here, I was recommending bear call spreads, right? Up here though, there was no trade. I didn't see a signal to go short, although we moved down below and the 50 has moved back below the 200. I think it's going to push it back down again. I'd like to see it go lower, and we'll look at some more bull put spreads or some bull call spreads in nat gas. Okay. One other thing I wanted to show you here is palladium. We've had some great trades. I mean, some home run trades in palladium where we've made a ton of money. There is no signal here. You can see as I move this thing up, I just continue. We're continuing to make new all-time highs. There is no divergence here. Remember when we pull back here in this pullback, I was hoping we would move up. We'd create a bed in the MACD, a bearish divergence. We did not. This thing just kept rising and rising and rising. So that means any pullback here is probably going to be bought. So the pattern I'm going to be looking for now in this thing is a little bit of a pullback like this, and then another run up to make an even higher high. Meanwhile, we'll get a pullback like this, right? We'll get that cross in the MACD, and then we'll kind of move up like this, right? And then we'll come in here, and then we'll start to roll over. And then when this rolls over again, like that, that'll set us up for divergence, and that would be the trigger to go short. Okay, I thought this would be it, but it's not. So that just means there's still a lot of money coming into palladium right now. Our last short that we did, we had members making anywhere from 22 to 28, almost $30,000 per contract within a 5-day period. So I'm watching this. So members, stay tuned. If you're not a member, I encourage you to come in. Just one of these trades right here, and you're you're golden. Anyway, that's what I'm seeing with these trades here. Members, we've got some dividend plays here we're going to look at. We've got some other hedges that we're looking at putting on what we call our gator. So we'll look at that. We'll look at a couple of other things that I'm watching in the markets. Otherwise, if you're not a member, I highly encourage you to come in and check us out. Have a great weekend, everybody. We got some great college football games on, some regional championship games. Should be fun. Enjoy the weekend, folks. I will see you. Members, I will see you this Sunday evening in our weekly market watch. Take care, everybody. Ciao now.